Hi everyone, and welcome to our first webinar of the year for the US markets, where we look at indices and some commodities as well. And I have to say, David and I weren't even sure whether there'd be very much to say today. However, given what has been going on, in fact, really what's been going on in the markets after Christmas, in the period between Christmas and New Year, and certainly what's since happened yesterday, my goodness gracious, it's been just a fantastic time to be a trader. But before we start, I really must draw your attention to the disclaimer that you can see on your screens. I know you've seen it many times before, not just in this webinar, but in other webinars and other sessions, maybe with other people. But this can be such a risky business. So please, I beg you, do not use money that you cannot afford to lose. So I think we really just better start, David, just go straight to the charts. What do you think, though? I mean, I don't think I need to recap what's been going on. Flash crashes in the Forex market, Apple, after Christmas, we had almost practically a V-shaped recovery in the indices following the sort of sell-off that we had before Christmas. There was no Santa rally. Some people said, oh, Santa's rally was after Santa had delivered his presents, so he decided to come out and give a stock market something to cheer about. We've got China, we've got Trump, we've got the shutdown in the US. I mean, it just goes on and on, really. I mean, I don't actually remember. I think I wrote on my Facebook page. David and I can't actually remember a time when it's just been the whole trading environment has just been beset by so many factors. And, that you look at the chart and you see a setup and it literally can be upended, really in the blink of an eye. Does that kind of invalidate technical analysis? Does that kind of invalidate what we say about trading, that we have to take what we call a three-dimensional approach, that we look at not just the technical, but we look at the fundamental picture, the related markets? This is covered for Forex. For those of you who've taken our Forex program, this is all covered in the Forex program. No, it doesn't. It simply means that in this fast-moving world that we live in, things just move that much quicker, and the correlations, the linkages, the relationships between the markets, they do exist. And if you want to read what I've been writing about, particularly to do with regard to the Aussie yen, which is a pair that is a proxy for what is actually going on in the indices and in the stock market. I actually started writing about it yesterday, just highlighting why it's so important to look at as a currency pair. This is from the perspective of Forex, but also from the perspective of even index traders, day traders. You've got to know what is happening with the yen, and that's why we have a yen index, because the yen is one of these currencies. It's a risk on and a risk off currency, and it's a currency of sentiment as well. So I think I'm going to pass straight over to David. Is that okay, David? Because he's got his charts all set up for the indices, going back to the daily ones. As I said, we had this this almost V-shaped rally back in just after Christmas. Suddenly, the sun shone, as it were, and we'll look at that, and also look at what is happening now, and what the potential is for trading some of the shorter, the faster time frames. Just very quickly, in terms of the fundamental news, I think we're done for the day. The last one was the ISM, which has come out at 3. My Forex Factory hasn't updated, so we're not going to. At least we don't have to worry about fundamental data for the next, until tomorrow anyway. Right, I'm just going to transfer over to Dave.
Just switching screens, should be coming up now. Anna's got NT7, but I've got the NT8 running as normal. And a very warm welcome to you all, wherever you are in the world. Certainly cold and chilly here in the UK, so I hope it's warmer where you are. And I hope you had a great holiday, and wishing you all a very happy new year as well. Just move my chat box out of the way. There we go. It's pretty interesting at the moment, and just to pick up on what Anna was saying, you've seen this layout before, but basically, if you are new, a warm welcome to you also. Top of the screen, I've got the 5-minute time horizon, I've got the YM on the left, I've got the NQ in the middle, and I've got the ES over on the right-hand side. And down at the bottom, just for context, I've got the daily charts for the same instruments. So I've got the YM, the NQ, and the ES, and scarily we are already on the March 2019 contract. So the daily just gives us context, and just picking up on what Anna was saying, this was the ridiculous rally we saw. I mean, the last 7 or 8 days over the holiday season, other than when the markets were closed, we've had these extreme moves. We had an extreme move in equities, and we had an extreme move in Forex last night. These are massive moves. And when you look at the volume associated with it, it really doesn't hang true. But of course, we always have to bear in mind that that volume is associated with a holiday period. So you've always got to caveat it. But, you know, by any stretch of the imagination, a move of this magnitude, which I think from memory was around about 1,000 points, it was just ridiculous. When you look at the volume associated with it, it's just so out of whack, it doesn't make sense. And the same is true certainly in terms of Forex, certainly in terms of the moves on the yen pairs last night. Absolutely ridiculous. Dropping, you know, 700, 800, 900 pips in literally minutes, and then reversing. And for those of you VPA traders, you know, I said at the time, look for the reversals. They are there. It's hard to take them, but they are there when the market is falling that fast and that quickly. You know, but the opportunities are there. Now, what's going on at the moment has been quite interesting. We've had the fundamental news came in about 30 minutes or so ago, bits and pieces. ISM, not terribly great. Decent employment data as well. But in terms of what is going on in terms of sentiment, the market is still pretty fragile. If I open up this is the NQ on 5. You know, we've got a nice hammer here. We've got decent volume underneath. We're seeing a rally off that particular scenario. You've got a pretty strong price support in here with this very solid line here on the blue. We've got another region here which was acting as resistance. That's now acting as support. So we've got 2 levels in here. I'll just pull this open a little bit. There we go. So we've got 2 price-based regions which are have been, one acted as support and the other was resistance and is now acting as support. So we're starting to see, you know, the opportunity for a potential reversal underway. Now, what's also interesting about this right now is, and of course, running the 3 indices like this, I say this a lot, that if you are trading an index, doesn't matter if you're an index trader on the ES or the NQ or the YM, run all 3 in parallel, because you get 3 views of what should effectively be pretty much the same chart. It's not always identical, but they are often very similar to one another, but they give you a different perspective in terms of volume and price action, because they're not going to be identical, but the general price moves normally will be, although you do see divergence from time to time particularly between, or certainly last year, between the NQ and certainly the Dow at any rate. But just going to over onto the indices, the currency indices. What we're seeing right now, this is I've got a 5-minute, these are all fast time frames, because right now, you know, it is very much the tenor of trading is fast trading right now, because we're on thin markets. There's a lot of volatility about. It is very much a case of smash and grab. Get in, take some, get out. Get in, take some more, get out. Whatever it is, you know, that is very much the modus operandi right now. This is the yen index. This is on 5-minute. We had this pretty strong rally, and now we're starting to see the yen sell off again, equally strongly. And we've gone below this region here. That's the yen. If I move to just get that out of the way, let's go to the dollar. We saw a strong move in the dollar. This was around ISM time, UK time here. Now we're starting to see the reaction back again. And the euro, We're starting to see the euro rally. That's been in pretty heavy sell mode throughout much of today, but is now starting to see some buying coming in. But it's really the yen index that I want to focus on. That's what we're seeing right now. We've seen that selling coming in. And what's interesting right now is if we go over onto, I've got the Aussie yen up on the multiple time frames here. There we go. And what was interesting at the time, and it happened about 15-20 minutes ago, was that the Aussie yen, this is on 5 minute again, was actually rallying whilst the indices were continuing to fall. In other words, before they started to find some elements of support. So the Aussie yen as a proxy for risk sentiment, if you will, it's not a perfect correlation. It doesn't work in a truly perfect way, but it gives you the sentiment for the yen and sentiment towards the market in general. And it was interesting to see that, as I say, about 15-20 minutes ago, equity markets were falling, but what the Aussie yen was actually rising, and that was reflected on the yen index. So in terms of a trading opportunity, it's very much a case of trying to put these pieces of the jigsaw together and view the chart you're trading with as much information as possible. Now, in terms of what is going on right now, we are still in a bearish phase certainly as far as the YM is concerned. You can see it on the trend monitor. We haven't seen any flicker of a reversal from if we call this a primary trend lower to a primary trend higher. And indeed, what we've seen in this little rally here, the buying volume was actually falling away on those two candles. This was a doji candle, but certainly in terms of sentiment to the upside, it wasn't looking terribly strong. That said, as I said literally just now, seeing this sort of candle come in, decent volume below, if that's an opportunity to maybe snick a few points out of the market, that's fine. But obviously it's caveated with the fact that the trend right now, the primary trend in this 5 minute time frame, is pretty bearish. We've got back to the volume point of control, this dash line here, the yellow dash line. Didn't really break through there. We've got a doji candle, but again, similar sort of volume profile. We're seeing a market that's trying to rally, but it's trying to rally on weak volume. This volume is falling away. We've got a market that's trying to rally. Is that going to go very far? Probably not, because if it were, then you would want to see some element of rising volume, which we're just not seeing at the moment. Coupled with that, the trend monitor is still bright red, no flicker of emotion. It hasn't transitioned into a darker color. It hasn't gone to dark blue. Nothing. It's just stayed bright red. We've got a pivot to the upside, and that's where we're sitting right now. Let's see what's happening on the ES. Similar sort of picture there. We're trading around the volume point of control. And if we break to the downside with further downside momentum, then on the volume point of control itself on the histogram here, we've got a low volume node in place immediately below. So if we move through there, then it's going to move through there relatively quickly. But we have to caveat that with the fact that we are trading around this region here, which is the heaviest volume on the chart right now, which is where the volume point of control, the fulcrum of the market, is sitting at the moment. Let's pop that back up. And down on the daily, this is where we are in terms of context with all of these. This was the really quite extraordinary rally. There was a certain amount of follow through, but in terms of the volume, almost identical. So again, it's telling you that this hasn't got legs, if you will. It hasn't got momentum. But then you've got to caveat that with the fact that we are in the seasonal period, and therefore these volumes will be lighter. But for this sort of move with this sort of volume, it just makes no sense whatsoever. And it's no surprise to see that rally now moving out, running out of steam rather, and very little follow through in terms of volume or momentum. Just see where we are with the YM. Let's pop that back up. We've got a little bit of rising volume on the selling. A little bit of buying in here, but nothing terribly terribly strong that's going to cause the market to reverse off what is the bearish trend right now. Let's move this out of the way a little bit. Sorry, I've got my chat box there over there where we are. And, you know, looking at this move, you're looking at 8-10 point moves. Well, that's, you know, $5 a point. That's $50. That's, you know, handy to have. You get in, get out, get in, get out. You know, that's it. This is what the market is about right now. Once volume returns next week, when the bulk of traders will get back to business, that's when you will see probably reduced volatility, reduced whipsaw price action, and more consistent price action as the volume returns to more normal levels for that for the trading year. But nevertheless, there are opportunities here. You know, we're talking 15, 16 points now. That's $80. We're climbing to, you know, nearly $100 if we break through this region here. Very nice. Thank you very much. Not bad. You know, and that's just one contract. Bear in mind, you might decide to go in with one contract. You might add a second, or you may go in with two and take one off. You know, you're scaling in, scaling out. That's your, for something you have to decide. You have to find what you're comfortable with. Am I comfortable with going in with 2, 3, 4, or 5 contracts, whatever it may be, and then taking those off as the price action hopefully develops in my favor? Or do I prefer a style of trading where I jump in with one? As this trend now develops, I've got some decent profit in the bag now, looking very nice, very healthy. Do I want to go and add another one on? Yep, fine, stick another trade on, another position. I've now got 2 running in the market. That is the difference between scaling in and scaling out. Scaling in is based on fact. It's based on something that's already happened because you've seen a price move in your favor and you're now deciding to build a position in the market. Scaling out is based on expectation, because in scaling out, you're making the assumption that you're going to be right. Very different style of approach. You have to find what works for you. Some people like scaling in, some people like scaling out. Some people like being systematic traders, other people prefer discretionary. We are primarily discretionary traders. It's what works for us. We're comfortable with it. We like to make the trading decisions. We don't want to abrogate that to an EA. You know, we understand what we're doing and quite happy taking the trades in that knowledge of all trading is decisions have been made by us, and we're comfortable taking the emotion that's associated with that approach. And that's where the indicators come in. They help you in assessing the information as it comes into the market. Nice move going on, very solid. And of course, you'd have this on different time frames as well. You'd have maybe a 1, 3, 5 combination, something like that. If you're down at the 5-minute time frame, really scalping out the market. And in addition to that, you'd be running on the tick charts and probably on the Renko as well. Let's just head back to our yen index, see what's going on there. Where are we? There we go. So we're starting to see that buying. We're seeing the selling on, oops, sorry, beg your pardon. I'll just pull that over again. There we go. We're starting to see that buying of the yen coming into the market as we're starting to see the sell-off in the indices. So we're seeing that relationship re-established once again. Be interesting to see what's happening on the Aussie yen. It's kind of quick. Yeah. Let's see what's going there. Okay, well, we're starting to see that that reflected there as well. So we're starting to see the buying of the yen coming into the Aussie yen. And what's interesting also, you know, another factor, if you will, in the equation is the volatility indicator. I've got 2 nice examples here. In fact, we've got several examples here. Big move lower, volatility triggered. What happens? Back inside the spread of the candle, instantly reversing. It's just classical entrapment by the market makers. Everyone would have been jumping in here on a fast move lower, thinking, easy money, let's jump in. And everyone's, by the time this move is underway, you know, the crowd is jumping in down here. Now they're trapped the wrong end of the market. And we've got exactly the same here. Market spikes. Let's jump in, make some easy money, quick profits on the table. No, bang, goes the other way. It's such a powerful indicator. It works on average true range. It's a very simple indicator, but it giving you a heads up. And the most powerful thing about it of all is these trigger in real time. So you don't have to wait for the candle to close. As soon as we've moved outside the average true range for this particular instrument in this particular time frame, it triggers. So you know instantly you've got volatility. You know the market makers insiders are playing, or they're not. If it's a trap move on low volume, then you know it's a trap move. But if they're playing in the market, then you know they're in there. And it's just a signal to help you understand what is likely to happen next. And what is likely to happen next is a move back inside the spread of that candle at the very least, and possibly a full-blown reversal. And there's another nice example here. Volatility, bang, what happens? Slides away into the spread of the candle and actually trades there for some considerable time. And the same here, we had a nice move up, then we're into there, and then we do carry on up. But the key issue, the key point is that from a trading perspective, the killer for you as an emotional trading emotion is that the longer this time goes on, the greater that feeling that you've got it wrong and you're on the wrong side of the market and you don't know what's going to happen. And all of that is bound up in the emotion of not knowing whether to stay in or get out. And that's really all it's about. It is that time element which plays so strongly on yanking the emotions of your trading brain into that uncertainty, which then leads to you closing out possibly early, and the market then quietly carries on in due course. And it's a very simple mechanism. So the volatility indicator is a very, very powerful indicator, but very simple.
Sorry.
Yes, darling.
Someone asked about think or swim. Am I right in saying that we can't actually do it?
Yeah, we've looked at think or swim several times. Thank you for your question, Jim, by the way. We have looked at think or swim. It is a nice platform. We will revisit it. I can't remember what the issue was, but there was something about it that made it very difficult for us as a third-party company. And I don't think or swim were terribly helpful. I may be speaking out of line. I can't remember, to be honest. But we will take another. We are always looking at new platforms. TradeStation is the next one we're working on. We've just done TradingView. TradeStation will be available in the next sort of 3 or 4 months, and I will pass that back to the development team, and we'll take another look at it, Jim. So thank you. If you have any knowledge of who we should contact or the best person to speak to, we'd really appreciate it, because we do like developing for other platforms. So if you've got any details that you think might help, please just drop me an email. It's david@quantumtrading.com. Be more than happy to take a look at that for you as well. Let's see, where are we going at the moment? This is the Renko on, and it's a really nice example of you get a sense of momentum when the market's moving fast. Look how fast those bricks are building really quickly. And that you don't see on a time-based chart. What you see on a time-based chart is the price action moving up and down, maybe volatility, whipsawing around as it builds the candle. But what you see on a non-time-based chart, like a Renko chart here, or a tick chart, is you see that aspect of momentum revealed. The bricks build very quickly because it's not dependent on time. It is purely dependent on the brick size. And what we've done with the Renko optimizer is make it to give you the optimal setting. So all we do is we just select our time frame. So if we select the 1 minute here, what the Renko optimizer then does is it then delivers the optimal setting for the Renko chart for that particular instrument on that particular chosen time. And we just click on there, and that will then build the associated correct brick size for this particular time of day and for this particular instrument. As you can see there, it's gone to 55, which is basically 5.5 pips for that particular pair. And it works exactly the same way on indices and everything else. Let's just go back to the indices and see where we are. Looks like we may have a bit of a pause point going on. Let's see. Let's have a look. Still ticking on down. Let's pull the ES up. Let's go to a slightly slower. Let's go up see what the 10-minute looks like. Okay. Decent candle, decent volume, not as heavy as the opening volume, but then, you would expect that anyway, because the session is now, over an hour old. Just go back, put it back to 5 again, so we've got consistency there. Yeah, so we're seeing a bit of a pause point come in. And if you've got some decent profit in the bag, you followed this down, you think, actually, do you know what? I think I might take my profit off the table. Or, as I said earlier, if you're scaling out and you started with maybe 2 or 3 contracts, for example, you may say at this point, do you know what? I'm going to take 1 off the table, or maybe take 2 off the table. I'm going to leave 1 to run and see if this move is actually going to develop further, see what the price action is telling me, see what the volume is telling me, see what my indicators are telling me, and so on and so forth. It's just a very different way of trading. Most traders start with 1 contract. We all do. That's human nature. You start with the very smallest contract you can of a particular market, and you learn your craft. But gradually, as you develop, then you become, you apply these other techniques and approaches to help build positions in the market. Because once you've got a good position in the market, it's great having 1 contract running, and you get 20 points on a YM and you've got $100 and you think, great, I've done well, and you have done well. But wouldn't it be nice if you had 2 or 3 contracts on that? You've got $200 or $300 instead of $100. That is the nature of the business. The corollary, of course, is you could be down $200 or $300 and maybe more. You have to find that comfort level, what works for you, what you're comfortable with, what suits your personality. We get hundreds of emails every week from traders who say, well, show us your results, or show us this, or how do you trade? It's almost pointless, because it depends on your time frames, and it depends on your time available, and more importantly, and perhaps most importantly, it depends on your personality, because what suits Anna and myself is not necessarily going to suit you. And that's really what it comes down to. It's finding what you are comfortable with trading in terms of the risk you've got on the table, and in terms of how you want to approach this whole business of making money from trading off these charts. Still looking pretty weedy at the moment. NQ, similar sort of picture there. We're trying to see a bit of a rally. We've got this very strong level. This is price resistance here, this wide dashed blue line. This is the accumulation distribution indicator on NinjaTrader, and it works on price. So what this is telling us is that there is a lot of price congestion, which is now acting as resistance to the price trying to move through here. Immediately above that, we've got the volume point of control. So we know we've got volume acting as resistance here as well, because it's the highest region of volume on the chart. And above that, we've got another region of price resistance here of the accumulation distribution indicator. So the wider this line, then the more dense that price action is, the more solid that wall, that barrier, if you like, to progress either higher in terms of a ceiling or in terms of a platform when it's below. And then you've got these lower levels up and down here. And a lot of the indicators you can tweak, you can configure, you can align them to increase sensitivity or reduce sensitivity. You can increase these levels or reduce these levels if you prefer, just to see the stronger levels perhaps. You can also adjust the trend monitor, for example, if you want to smooth it out so that the congestion phases are longer, and then you see the trends develop more strongly. It's all a question of what suits you and trying to attune the indicators to your trading style and what it is you're trying to do. And when you trade as a scalping trader, you might want to have them tuned in one direction. Maybe as a long-term trend trader, you might want to have them tuned slightly differently. It's all a question of balance and finding what you like and what works for you. Let's just go back to the let's just go and see what's going on in commodities very quickly. Let's go up to commodities. What's been great for some markets is not good for others, but certainly in terms of gold, I mean, oil has been incredibly volatile. Again, it's another one, amazingly volatility over the last few days, but this is gold. We wrote about gold, I think, a couple of weeks ago. Yeah, middle of December, and we suggested that. Okay, we said it wouldn't get to 1300 before Christmas. It was certainly looking a nicer end to the year for gold bugs than certainly the start's been. So that's been a pretty solid move. We're now getting up to this 1300 region again, which has tended to cap these moves in the past. But depending on what happens in equities, depending if we see more volatility in Forex, if we see more flight to safe haven, then that's always good for gold, and that's been rising nicely since this was the start of December, supported by the trend monitoring. You can see no flicker of emotion there, just solid blue throughout. We've had some, but you can see here how the volume is really falling away if you compare it over to the sort of, this is October through November. These are typical trading volumes, and then gradually as we move into the holiday season, it tails away. But that's natural, that's to be expected. Oil's been hugely volatile here. I've got the Renko running on oil. Just move that chat box out of the way again. Sorry about that. There we go. And it's a great scalping tool, just used in isolation. I've got the trend dots on here. I didn't have the trend dots on the other charts, but the trend dots work very close to the price action. They work really well with the Renko. I haven't got the trend monitor on here, but that works really well too. And when you're using the two in combination, which is what we recommend, use the trend dots with the trend monitor. The trend dots will always change first. The trend monitor will always transition second, but they're great working in combination and fantastic on the Renko. That's on oil. This is on the standard time-based chart on 30-minute. A lot of volatility coming in. This is what I said earlier about the volatility indicator. You can see it triggering here. It's in real time. This candle hasn't closed off yet. Just pull that up, make that wider. There we go. Hasn't closed off yet. Apologies, I have a appalling cold at the moment, or sinus, something or the other. That's why I sound a bit bunged up. But you can see here, it's been triggered. We know we've got volatility in the market, and it's giving us a heads up. Now, if you were short that position right now, you've got a decision to make. Do I close out? What do I do? I've got volatility. I know the big operators are playing in this market right now. Should I close out if I'm short? What do I do? I've said this many times before. Normally, and this is a personal view, normally what I would do if I had this in the position, then I would close out, take profit off the table, because my expectation is that this market, if this closes with the volatility indicator, with a wick of any description to the underside, then I'm expecting the market to retrace anyway inside the spread of that candle. I've also got some other factors here. I've got some decent volume in this region, which is going to act as price support. I've also got some price support itself here with the dashed line below, and you can just eyeball it. We've got quite a wedge of price action here, which will act as a platform of natural support to the market in any case. So there's two or three factors there to suggest that that's what's going to happen. Now, clearly, we're in oil, so we could be ambushed by anything. We could be ambushed by Trump, we could be ambushed by OPEC, we could be ambushed by some fundamental news, all sorts of things. But from a purely technical perspective, those are the sorts of things you'll be looking at right now. Yep. I'm just going to move back to Anna, just to wrap up. Sorry, this is a relatively short session, so apologies.
Oh, thank you. Poor David. I think I made him suffer today. I know we're talking, we do these sessions are really day trading, and when we say day trading, it's going to be looking at the indices in particular. But I just wanted to show my my workspace for the Aussie yen. We talked about the Aussie yen in terms of it being a kind of proxy for market sentiment, because it's got a yen in it, and etc. etc. But I just wanted to highlight something that as traders, day traders, medium term traders, long term traders, is we have to face, and that is when we see price action that we see here. Now this happens to be the 3-minute chart, but you'll see this this type of price action in all time frames. And what we've seen here, we've seen volatility. We've seen a sharp move lower. Then we saw the volatility candle triggered. We saw a retracement back into the spread of the candle. Then we saw some buying come back in. We can see this from the other at the wick on this candle. We've supported by the pivot, a reasonable amount of volume underneath it, and it was enough to precipitate this move back to the volume point of control, where we had a sharp move higher. Again, volatility triggered, reasonable amount of volume underneath it. Again, because of volatility, the indicator retreat back into the spread of the candle. But that is on a candle by candle basis. But the kind of price action we have at the moment is essentially we are rotating around the VPOC, and the VPOC is at about 75. 75 is quite an important level for the Aussie yen. And when you're faced with this kind of chart, as it were, on anything, because as traders, the vast majority of traders they're reversal traders. They're reversal traders in the sense that they buy low and like to sell high, and that's whether you trade or whether you invest. But realistically, a lot of instruments, a lot of the time, are in this type of this type of phase of price action, which is a congestion period. It's rotating around that's why we've developed the volume point of control, where we look at volume, time, and price. And you have some decisions to make. You can either say, I recognize this phase of price action. I don't like this phase of price action. It's really not for me. And I'm going to wait until I've had a strong pull away from this region, and I'm going to look for, as I said, these reversal points, which is absolutely fine. And you look at those reversal points with the help of indicators. This is Forex, or we look at something like the CSI. And the candle patterns. I mean, it's very, very straightforward, but you can actually miss out on a huge number of potential trades if you are prepared to look at congestion periods in a more positive light, not see them as frustrating, but look at them and think, do you know what? They can actually offer potential for really nice trades. Now, hopefully this will come up on the daily chart. Now, forget the candle. This was just the extreme case. But if you look at this, is the daily chart, and the if you like, the negative publicity comments about breakaways is that you get so many fake outs. Oh, you look at a breakaway and it's a fake out. And certainly looking back on this price action on the daily chart, but this could be a 5-minute chart, a 10-minute chart. Price action is self-similar. You'll see the same thing, the same patterns repeating, whether you're on a 1-minute chart or a 1-month chart. And yes, I do agree. It breaks away and then it comes back again. It breaks away and then comes back again. But what happens is, if you do, all things being equal, you do take the trades, your losses are actually very contained, because what the VPOC does, it kind of defines that place on the chart where your stop loss is going to be. So if you're going to move to the downside, it's obvious where your stop loss is going to be. It's going to be above this the volume point of control. And similarly, if you were going to take the trade to the upside, the downside, your stop would be at the most significant support line. Now, what happens is, if you believe in the trading theory that you should keep your losses small and let your trades run for as long as possible, this is just a really nice example, because when it did actually pull away, it did actually develop a really nice waterfall. Now, we had a little bit of volume falling away on that candle. That was still weak. We had an up candle there, but look at the volume underneath it. So if you liked as well, that's awfully interesting, but it's not going to go very far. Then we had a lot of volume coming under there, and so on. And I know we're going into Christmas and what have you. And of course, we have this ridiculous candle because of the circumstances and what have you. But under normal market circumstances, conditions, you will see this type of price action all the time. So what I'm saying is, don't be put off by congestion periods. It's where trends are actually born. I know we have reversals. Reversals are very dramatic. You have lots of volume coming in. You have distribution phases. You have congestion phases. But don't don't be afraid to look at breakaway trading because you think, oh, there's so many fake outs. I go in and I'm stopped out. I go in and stop, because when they do, when they do take hold, they can travel, quite a long way. And to return back to where we are at the moment on the faster time frames, this is at the moment that our levels are clearly defined here on the Renko, with the pivots to the top there and the pivots there, and it's going sideways. And what we also need, the one quality we need when looking at a chart that is in congestion, is patience. And I suppose if there was one quality that I think we ought to be putting on our New Year's resolution, David, is patience. David is extraordinarily patient. He just, he defines patience, and he's rewarded for it. So anyway, that's all I was going to say. All it remains for me to say is to thank you for coming along today. We're going to cut it a little bit short because, as I said, it's we did a webinar about 20 minutes before we started this one, but we'll be back to our normal timings certainly next week. If you want to know a little bit more about the indicators that we have been using on our charts, you can find details. Oh, that's my side. That's the post, by the way, talking about gold. Where is it? Where is it? Here we are. Here we are. This is quantumtrading.com. This is the information on the Ninja indicators. There's the full package, which is 1197. You can pay for them on an easy payment plan over three months, but you don't have to buy the package. You can just buy one indicator. And if there's one indicator, I would urge you to consider over and above everything else, and that's the volatility indicator, because given the state of the markets at the moment, you want to know when volatility is coming in, and it triggers in real time. And it's $57, David, isn't it?
Yeah.
It's $57. As I said, it's a fantastic indicator. It will just help you so many times. It will keep you safe, and it will also highlight, as I said, these potential reversals, particularly when they come seemingly out of the blue. That's all I've got to say. Anything you want to say, David?
No,
we're back next week.
Apologies for my drains.
Apologies for David's drony voice. What I was going to say, quickly whiz through here. This is our education program is for Forex, but if you want information on anything that you've seen today, you can drop me a line at anna@annacooling.com or david@quantumtrading.com. So enjoy the rest of the trading day, the trading week, and we will catch you next time. Thank you so much for coming along today. Bye.